I think it's very important for us to understand how we can use sentiment analysis to guide our long-term stock investing decisions. How to use sentiment analysis to guide, long-term market long-term stock investing decisions. While sentiment plays a key role in short-term market movements, it can also influence long-term stock investing decisions. So here's how investors can use sentiments to guide their long-term strategies. So in this video, I want to consider precisely how we're going to use these should I say infamous sentiments to actually guide our long-term investment decision. Number one is identifying undervalued stocks. Identifying undervalued stocks. So in this case, you adopt what is called a contrarian approach. A contrarian approach after you've identified undervalued stocks. So negative sentiments can often lead to overselling, causing stocks to become undervalued relative to their fundamentals. Just like I've said, positive sentiments can force stocks to go up. Negative sentiments can equally bring down the value and the prices of stocks. And by identifying stocks with a strong long-term prospects, that are being unfairly punished due to short-term pessimism, investors can find opportunities for long-term growth. You discover so that are undervalued because of excessive negative sentiments. You be keen to these companies because eventually the companies and stock will grow and you will make money, as a result. Not only that, the sentiments, as a signal for market reversal, the sentiments actually could be classified as it could indicate a kind of signals, signal for market reversal. So when there is an extreme pessimism in a sector or stock, it could indicate a bottoming off, offering long-term investors a chance to buy at a discounted price before sentiment turns positive again. Generally, when they're in an atmosphere of negative sentiments, stock prices are down, you could use that opportunity to buy great companies at discounted prices, waiting for when sentiment will eventually turn positive, because it will. When it turns positive, it will drag the stock prices, drag stock prices up again, and you will then create wealth as a result. Number two is tracking market cycle. Tracking market cycle. In other words, how to use sentiments to track market cycles. And so in this case, you consider bullish sentiments and market expansion. Bullish sentiments and a market expansion. A prolonged period of positive sentiments, especially during a strong economic expansion, can drive stock prices high. It can cause stock prices to go higher. So investors can use sentiment indicators to assess whether the current market optimism is sustainable or overly inflated, helping them make informed decisions about when to enter or exit positions. So we also want to see bearish sentiments and market contraction. Just like bullish sentiments, leads to market expansion, bearish sentiments can, cause a contraction in the market. The negative sentiments, often coincide with market correction or recession. Generally, the market will correct itself. And typically, in a typical economic cycle, you have expansion, and equally you have a recession as well. So while these periods can lead to short-term volatility, long-term investors can use sentiment, and they can use the negative sentiments, as a signal to accumulate high-quality stocks, at a discount, from a future expectation in price growth. So you use that time to, if you have sufficient cash, to buy quality companies at a discounted price. So when eventually the market, the bearish period is over and a bullish, period sets in, you discover that you make a lot of money, as a result. Number three is assessing the stability of companies. You can use sentiment to do what? To assess the stability, how stable are the companies you want to invest in. So in this case, you consider, company specific sentiments. There's there's general market sentiment. There's also, a kind of company specific sentiment. So positive sentiments around a company's leadership, innovation, or growth potential can signal, strong prospect for long-term investment success. Sentiment analysis tools, can help investors track news, earning reports, and social media, to assess public perception of a company. How does the public, perceive this company? If the perception is positive, then the company will likely, do well along the line when it comes to, its stock price. And also, you also monitor shift in sentiments. Apart from considering company specific sentiments, you take into consideration and shifts in sentiments. So negative sentiments around a company due to poor financial performance, scandals, or management issues can signal potential long-term risk. So monitoring sentiment changes can help investors adjust their positions before these risks materialize into greater losses. Once you perceive that investors are no longer favoring a particular company, once negative sentiment comes in as regards a particular company, it's high time you think about selling your position so that you will not incur losses as a result. Generally, negative earnings or losses in the company could trigger negative sentiments. So when this happens, the best thing for you to sell your stock so that you will not record losses. Please like this video and subscribe to this channel. So number 4 is sector and industry trends. Sector and industry trends. In this case, you talk about sector sentiments for long-term growth. You consider sector sentiments for long-term growth. So positive sentiments surrounding certain sectors like renewable energy, technology, or healthcare, can indicate a long-term growth potential. And sentiment analysis can also help investors spot emerging trends early, positioning them in stocks that are likely to perform well over time. So once you spot a positive trend, don't just fold your hands. Buy that particular company stock, believing that all things being equal, the stock will recover. So you call it sector rotation strategy. Sector rotation strategy. By tracking sentiments in different industries or sectors, investors can anticipate sector rotations. When money flows from one sector to another, that's what they call sector rotation. People will sell their shares in a particular sector and then will buy more of them, companies, from the other sector, from another sector. So these are things we need to, consider. And they adjust their portfolio according to benefits from long-term sector growth. Whichever sector is doing very well will attract investors, and that will kind of enhance growth in that sector. Number 5 is investor sentiments for market timing. How to use investor sentiments for market timing. So in this regards, we want to talk about sentiments as a leading indicator. Sentiments could be an indicator on its own, actually. So example, extreme levels of optimism or pessimism can act as a leading indicator for future price movement. Whenever there's a kind of extreme, pessimism or extreme, optimism, euphoria, whatever, this behavior will certainly indicate the direction, of a company stock price in the very near future. So, for example, when a sentiment is excessively bullish and valuations are high, it might suggest the market is kind of overheated. It might be getting towards an overbought state. So, making it a good timing to consider reducing your exposure as the market is going up. Getting into an overbought stage. Market, the prices are becoming too expensive. This overvaluation is important. You start to reduce your position. So we also consider rebalancing strategy. So using sentiment indicators as part of a broader portfolio rebalancing strategy is very important. For instance, if sentiments turn overly optimistic and stock prices rise significantly, it may be a good time to take profits and allocate funds into more defensive, undervalued assets. It's required that whenever stocks become overvalued, overpriced, what do? You sell and reallocate your fund, your capital to stocks that have potentials but that are considered undervalued. In this case, you may need to apply value investing. Number 6 is a long-term momentum and sentiment. Long-term momentum and sentiment. How do they connect? How do they interrelate? So in this case, you take note of momentum indicators. Momentum indicators. So positive sentiments, can lead to a long-term momentum, driving stock prices higher over extended periods. Whenever sentiment is positive, the next fact is that you start observing stock prices going higher. So investors can use sentiments to identify stocks with sustained positive outlooks and strong growth potential, supporting a long-term investment thesis. You could use sentiment to be able to determine or detect, stocks that would perform, very well in the long term. So sentiment is not always a negative factor. You could harness sentiments to guide your investment decisions, along the line. So in this case, you also look at a sustained sentiment shift. Sustained sentiment shift. So if sentiments around a stock sector or economy shift dramatically over time, it can influence the long-term growth. It can influence the long-term growth trajectory of individual assets or stocks. So identifying such shifts early enough allows investors to adjust their portfolios to capitalize on those changes. Usually, when it comes to investing, you should be proactive as much as possible, not just reactive but proactive. If you discover that if you carry out a sentiment analysis and discover that a stock is about to go up or down based on your analysis of sentiments, then you could either buy or you sell your position.